Hey everyone. Wanted to jump on real quick today and just briefly discuss why the developing your own system is going to be disproportionately beneficial for how you actually manage over the long term your system expectations and the iterations that your system will go through once you deploy it and start getting feedback from your forward testing in live conditions. So having published some open source or one open source script and gone through some iterations of that from the previous series that we did on coding for price action, one of the things I've noticed, especially on TradingView, but all across the trading spheres, is folks selling either indicators, selling systems, selling complete systems, selling indicators that can do, quote unquote, back testing that will tell you what the highest probability scenario is to execute under this specific condition. And one of the things and it might be that they're using some, valuable inputs, perhaps. Many of them now tout that they use AI to do it. No doubt that if there's sufficient data manipulation that needs to happen, they could probably do it. But in the case of AI, the input data has to be meaningful to begin with, right? So you wouldn't want to be capturing, say, derivatives of derivatives, and then throwing all of those into an AI algorithm to determine the highest probability configuration of all the derivatives to perform X, Y, and Z, right? So all of these abstractions that most people in trading spheres market will never result, no matter what the numbers look like, will never result in long-term sustainable performance. And this is simply because most of it comes down to beliefs. If you don't trust it, if the systems that you are executing based on, or the signals that you're executing based on, do not reflect your underlying beliefs about market behavior, then you're never going to be able to trade it. And this is where spending the time to develop your own system becomes disproportionately beneficial. I'm going to just share my chart, unless someone has a question. You can take a question first. But I was going to share a chart that, and I think this is something I've shared before, of one of the systems that I built with a number of different signals that the system generates. So let me just double check which. Okay, is this one? This is the teaching. Okay, so let's take a look. So this is the AMA breakout paint bar that we use in PTM and Systems Academy. So that's the bars are being colored according to a configuration of that. But the signals you see above and below the bars, and in fact, we could just turn off these signals so we just see the actual system signals. Okay. So naked chart and trading signals. So all of these signals are based on, and there's 7 different signals that the system provides. So each of them are subsystems of the main system. But the idea here is that each of them requires, the system itself is based on my beliefs about the market, my beliefs based on the research that I've done, and the way that I validated it in back and forward testing, and then my experience trading the system and the things that I've needed to do in terms of the management and exceptions that I allow. Like, this is not a fully automated system. These are signals that the system generates, and that then I have to decide how to execute based on the binary decision trees that we suggest everyone uses, especially in Systems Academy when you're developing a system. So, for example, the red circles are fade signals to sell above. Green are fade signals to buy below. Pluses, green pluses are buy on a pullback within the range of the bull bar, and the red signals are sell on a pullback within the range of the bear bar. And these are very, very flexible signals because they are designed to reflect the underlying first principles of price action and to assess every bar the same way that a discretionary trader would in real time think about whether the market is in a trend or a trading range and whether the bar is a breakout or reversal bar, whether it's a reversal breakout or a breakout bar, um, or not. And so all of those are inputs, and then the system determines what the signal should be. And then the human trader, because this is not automated, determines how to trade it. But I couldn't give this system to anyone and expect them to trade it. That's simply not practical. And it's not practical because, oh, sorry, I should have maximized this. My bad. There we go. You don't need to look at me. So the reason is because there's simply no way for someone to understand in depth the principles that the system is based on and have the confidence to actually execute it and to adapt to the variety of nuances that it introduces. For example, the signal on 33, sell above. It's a sell above, but the last two bars were trading range bars in a second leg, and it's a trading range signal. So you wouldn't want to sell above. You wouldn't want to sell on a pullback into that bar because you're functionally selling at a trading range low. What it's saying is that that the conditions right here within this 3-bar area are this is a trading range right here, and that's true. It's a variant of a triangle right here, but you wouldn't want to sell into a pullback. You would want to sell above at least one measured move, if not at the previous swing point. And then you get a sell above signal here. This is too strong of a close. So you imagine that, it's uncommon to see here this very similar scenario, bar 34, 41, and 43. All of these are sell above signals, but you typically want to wait at least one bar. Here you wait one bar and you don't get the reversal. Then you sell above the second signal. And so there's a variety of those nuances that you need to understand and study in order to execute this properly. And all of this is, again, based on price action first principles, right? There's no derivatives in any of this code. It's all based on bar structure, the geometry, the relationships of bar to bar. So it's doing bar by bar analysis the same way a human trader would, but with the caveat that it doesn't allow for any of the nuances that the human trader can bring. And that's really where you see that really disproportionate benefit for the human trader. Yes, the confidence is everything. And confidence in a system is a reflection of how closely that system reflects your beliefs about the market. Right? It's almost impossible. I would argue that it is impossible for you to have confidence in a system which violates your beliefs about how the market operates. I don't think it's possible. Because you would be constantly at odds with yourself. And Al says it, Ali says it, you have to, if anything is wrong, everything is wrong. Right? And starting from a violation of your beliefs would be starting from perhaps the worst starting point for any trader to sit down and try to operate from. Here, Tom says, can I leave a question here and to get a response? Al, for 1.5 years, pro mentorship for 2023. Oh, sorry, there's 2 questions. Yeah, it depends on your goals. There are some people who end up just doing PTM and have an incredibly meaningful experience there and just work through that program material. There are those who still want to still want to develop actual, systems, formal systems, rather than spend the time learning and doing the research and homework methods that Ali introduces in PTM, to actually go through the formal process of building a system and to do it in a group of others who are also building systems. That's the other significant benefit of SA2, is that while you can build a system formally on your own, while you're in PTM, there might be a couple of other people who are doing that as well. Everyone's doing research. Everyone is incredibly dedicated and hardworking. But it's different when everyone is going through the formal, pedagogy of the SA2 program. So slightly different, actually significantly different, but just depending on where you are in your development process, working through the PTM material is a fantastic starting place. You don't really, it doesn't get much better than that. So you're already doing great if you're there. Good times. Yes, I trade this. I trade variants of this. Right now, I'm not trading this system all day. Right now, I'm trading on the 100-second chart. So I'm trading slightly different system on the 100-second. But I mainly wrote this as a research project to see how simply I could code a meaningful signal system based on price action first principles for SA2, and just seeing what I could do. And this has very few rules. It's basically just doing bar by bar analysis. So it started as a very simple project, and with the idea that the signals and system needed to be robust and based on things that would not change. Obviously, that's price action. And it's proven to be very good. And I traded it exclusively for 6 months. And often I will take, trades that align with this. Like, for example, today, I bought on a lower time frame, I bought the pullback on 21 for a test of the 16 low, sold the 16 low, and that aligned with the test above the 20 high. So basically just taking trading range trades in this consolidation after the big Z-bar breakout on 17, right? Anticipating that this would get at least a 50 to 75% pullback before any attempt at continuation, but also that it would be a low probability that 17 would get a full measured move, given the amount of the average daily range that the session had already traveled. But we'll see. And I'm done trading for the day. So hence the stream. How many trades should we test the system for before analyzing results? Basically, you want to start by getting a baseline. Just understand whether your system parameters are reasonable, and between 30 and 40 trades. But then you can't really understand a real system, the real system performance, until you have about 100 trades. So, how to translate? Yeah. So oh, okay. Well, I don't know if it's K or Kai. If you bought that, we are actually going to update the breakout research paper to include the translation that I did of the code to PineScript. So you should have that. I'll make sure that we add it this weekend, so you don't have to worry about it. You'll have that translation. I apologize for the delay in that. So I just wanted to jump on and. Okay, I was going to say if no one has any more questions, but we have questions. How do you manage risk reward if every trade has different stop loss and target points based on support? No, so risk is a matter of the bar. So I don't use average bar range. I use the actual bar range of the signal bar, and because the signals that I trade are based on individual bars. They're not based on pairs of bars or Occasionally, they will be if it's a reversal and follow through signal, and the signal generates based on the performance of the follow through bar. But for the most part, they're individual. They're signals based on individual bar ranges, and as a result, it's very straightforward to calculate risk. And it's trading with it doesn't really matter how many lots you trade with. You just subdivide your risk accordingly. I will scale in up to 3 times, but it's very uncommon for that to happen because I am aiming to enter on limit orders at second tests that correlate with signals. And as a result, um, if the initial entry is violated, getting a second legitimate signal that would allow a scale in opportunity is not that common. It's more common that if the signal doesn't perform, then it would end up violating the signal premise to begin with, and I would have to cut the trade. So, um, yes, I can scale in. Everything's based on individual bar ranges and the risk that they suggest, and yeah, it's really straightforward to calculate. Um, the red, green, blue circles. So I went over those at the beginning, but the red and green circles are buy below and sell above. The squares are the plus and minus are or sorry, the plus signals are buy and sell on pullbacks, and then triangles are trend signals. Triangles and diamonds are trend signals. Uh, Sajad, there's no difference. It's just the way that Ali teaches it, especially through the breakout white paper, is just slightly different. Um, yeah, the specific research that he's done was based on the signal conditions and specific signal setups and limit order entries versus stop entries. And so there's different calibrated expectations when you're taking limit order entries versus stop entries. And so it's just a different approach to evaluating the way you should treat the breakout. But it's still the same. You're still looking for all of the conditions that that Dr. Brooks would consider valuable and monitoring it in the exact same way. You're just entering and managing based on different research for limit orders versus stops. Um, I use so the actual risk of a trade is not as important to me because I'm not. Yeah, for me, it is the initial risk is what I am concerned about because that is what I use to structure all of the trades. Actual risk, I haven't done studies on actual risk. I default to Dr. Brooks there. And for those who are swing trading, for whom it is much more important than for me as a relatively high frequency scalper. It is uncommon that I see my full initial risk even tested, but when it is, I know the probability, and that if it gets hit, then I need to be out, and I will scale in. And for the scalper, then those are the situations where you take larger losses, and they happen. Ali calls them shark bites in your P&L, and you know it's not the end of the world, and it's part of what you accept and expect. But as you condition your calibrated expectations, it becomes much easier to cut trades early than see your initial risk even challenged. Um, The only time that that initial risk is ever really hit would be on those surprise bars, like 7. So, like, if you had, say, bought the pullback at, on 6, anticipating that that micro gap, the body gap would get tested on the somewhere in the range of 4, and you had been waiting for a retest on 7 of the 5 high, and instead you got 7, and what we actually saw, then yeah, your initial risk is what you take for the trade. I hope that answers your question. 370 trades is well more than is more than you need for to assess the results. As long as you've done the research accurately, as long as your data is good, and you're not biased in your collection, then yeah, 370 trades is more than enough. The only reason to study more than that, to collect more data than that, would be if all of those were collected from the same either volatility regime or higher time frame regime, and you need to better understand the calibrated expectations for, say, your signal, bull signals in a bear environment. But as long as you have a reasonable distribution of those signals across all of the variety of scenarios, that we will see intraday, then yeah, that's fine. All right. Well, this is a big question because it depends significantly on how you are structuring what you are using as your signal. And so, if it's simply a breakout, if it's a breakout and follow through, if it's the range of the entire leg that contains the breakout and follow through, if it's what we talk about in Systems Academy, the I1R, like there's a lot of ways to structure a trade around the premise that most strong first legs get second legs. So I can't really. So for a 3 bar micro channel, um, it depends. You gotta. It depends how you are assessing your 3 bar micro channel setup. Like if you have requirements for the amount of gap on the gap bar in the middle. If you're not requiring a gap, if you're so it just depends. And this is really where the research process will tell you. And this is what I tell all of the students in Systems Academy. You let the market teach you, and this is again coming back to, and this is why uh, this is the reason for this entire stream. Anyone who is selling a subscription to an indicator or to a back testing system or to some kind of anything that you haven't researched or developed yourself is not going to work, because you didn't go through the hard process of validating that these ideas reflect what you believe to be true about the market. Until that happens, it's not going to work. And the reason is because going through that process, you let the market teach you how to value the system. Like you don't impose your ideas. You say, these are the things that I think are true about the way the market generally behaves. Strong bars do X, Y, and Z in X, Y, and Z scenario. I'm going to structure a study around this, collect the data. The data shows you that that's just simply not true. It's like, well, you reevaluate your ideas. But if your premise that you use to organize your research turns out to be statistically significant, which is one of the things we start with in Systems Academy, then from there you can begin to do meaningful iterations on that to optimize and further refine the way that you treat all of the subsystems within the signal generator or the management or the reentry or any of the other components that go into actually trading a system. Um, but coming back to your placement of the initial risk for a second leg system beyond the first bar could be good. But in some scenarios, like let's say the microchannel is includes two Z bars, right? It's a climactic leg that's maybe is breaking out on a higher time frame, right? How do you treat that differently? Like you're going to have subcategories of legs which need different types of management, and this is what we deal with towards the end of systems academy, as students have worked through all of the preliminary, more generalizable conditions of their system, and they start introducing optimizations. The optimizations is when you really uh, when you begin to account for all of the nuances in the way that your signals appear, and what the market is telling you you should do differently based on each of the ways that they occur. And so my suggestion is to collect data on 100 trades and define that for yourself. Start with collecting data on stock where you currently have it, but then figure out whether that's really the best place. And I'm not the one to tell you, because uh, it's a good starting place, but it's probably not the best place for every 3-bar microchannel signal that your system produces. Um, this depends completely on the system. There's an absolute number based on uh, the actual system performance ratio, the win loss ratio, that will determine what what the highest number of consecutive losing trades will be. And so obviously that's an outlier scenario, but it can happen. And so that's the thing that you need to be prepared for in the worst case, whether it's 7 or 11, consecutive losers. But for me, I value trade frequency over anything else. The trade frequency and high probability. And because of that, I focus on, scalping. And I'm not terribly worried about holding trades for swings. Um, but yeah, it depends on the system completely, and what the signal is, the frequency of it, the risk reward. It's the drawdown period will be quite variable. But for example, for someone who is scalping, similar to the way myself, Brad, or Ali does, um, you're not going to have long periods of drawdown because your signal frequency is sufficiently high that anytime you take a loss, you're going to have 3 or 4 or 5 more signals that day that you can use to recover from any loss, even if you've scaled in the case of a scale in loss. Z bars are bars that are statistically large. We use the measure of Z score to determine that. Z score is just the normalized standard distribution, or standard deviation rather. So um, yes, yeah. Start with his breakout white paper. Start with Ali's breakout white paper. Then, if you feel like you have gaps, PTM recordings are fantastic. Many people have gotten incredible value out of those. Beyond that, Systems Academy. So that's kind of the scaffolded approach that you might take. Uh, Minimum scalp trade size. You mean like bar range or minimum position size? Oh, sorry, minimum point target. Yeah, I mean, I'm not going to take, like, well, I also don't usually take tiny bars. So, like, for example, um, if I had the signal, that's a good example here. Let me see. Today has high volatility. So let's look at yesterday. So 69. 69 is a sell above signal. Actually selling that and only targeting the low of the bar would not be a, I would not take it with that as my target. Let me just see what the tooltip says. This is, yeah, so that's 2.5 points. Actually, no, 2.5 points is sufficiently large. These bars are going to be smaller. Yeah, so 1.5. It really depends on context. Like this signal, obviously, and actually based on the way that these signals appear, selling here is reasonable. This is a Z bar. You can see here the full Z score is 3.98. So that's a very large Z bar. Very likely to get pullback, but also likely to get a retest. So selling above here, reasonable. It's also a little more than a 50% pullback. But then when that fails to retest the lows and you get the trigger on the low one, and then buy here, the probability is that these signals will fail. And especially when this gets a strong close above the previous sell above signal. So one of the things that you can do once you understand your system is actually use the system to create positive feedback loops with the way that you conduct your price action reading if it's based on price action first principles. So if this trading range signal fails here and the second one generates on a strong close, it's even more likely that this one will fail. This is a negative Z-score bar, which means that it is statistically small. This is also statistically small, so negative, 0.42. So any bars that are very small typically need to, you have to do different, trade management. Stops have to be wider. You can't use a single bar range. You typically have to use 2 and 3 bar ranges for your stops because, what is the what would a smaller bar represent? What would it be telling us if we see these smaller bars? Anyone want to hazard a guess? It's volatility contraction, right? So there's two things that can tell us is if the market's going sideways and you see volatility contraction, then it's basically a variation of breakout mode, and you are very likely to see some kind of impulsive move. And if you have a stop that's only one measured move away from a small range bar, then it's very likely to get hit. So as a scalper, you just wouldn't do that. You have to use 2 or 3 bar ranges as your stop location in that case. And as a result, it's typically not great to structure trades around that because then you're basically getting 0.3, risk to reward. That being said, if you have something like what we had yesterday, where rather than being sideways, it's volatility contraction and trend behavior, then that's basically a variation of a small pullback trend. So a leg as a small pullback trend. And then you can treat it differently, right? So tests back inside of bars you can buy, anticipating that you're going to get pullbacks. So you can buy below bars, buy inside of bars. And so again, all of this is stuff that you would derive from the research process of investigating the system first principle and then configuring the signals to reflect that, and going then optimizing everything over a period of subsequent research studies. They shouldn't if it's based on price action first principles, they should not be widely the variations should not be that dramatic. The only differences that you might see would be, okay, so like here, 4cc microchannels. You're going to see more of those in something like crude versus an equity futures market, like a Russell E-mini or NASDAQ. But I don't know about US 30, whether that has more of your individual equities behaviors where you'll see more intraday trends, so more consecutive closes than you would with an index like the 500. So it should not be that different, but you have to be, as long as the underlying markets are similar. So there will be different distributions of signals, based on like gold and crude are going to trade. You're going to have a different signal frequency for 4CCs in those than you would with when trading, the S&P, for sure. I don't know if that helps. If you draw it as equity curve lasting between. It depends what the win rate is, but that's 20 to 30 trades of consecutive trades. That would be a lot of consecutive trades if it's a high frequency, if it's a high probability system. High probability system would be uncommon to have that many trades of drawdown unless you had 20 to 30 trades when you. Oh, okay. So 20 to 30 trades when you are in a drawdown after perhaps taking a large loss that you scaled into. We'll come back to that. I ignore signals all the time. That's the reason for having high signal frequency. One of the things that makes swing trading so difficult is that in order to maintain the edge, you have to take every signal. You can't miss swing signals, because if you miss the swing, then it ruins the system performance. Whereas with a high frequency signal system, let's just count the signals here. 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, 14, 15, 16, 17, 18, 19, 20, 21, 22, 23, 24, 25, 26, 27, 28, 29, 30, 31. So 32 signals yesterday. Many fewer today. So today was 1, 2, 3, 4, 5, 6, 7, 8 so far. So this is a buy within the buy range of this bar. So get this pullback, you could buy the high of this bad sell signal bar. That's one of my favorite entry mechanisms, is to buy on a test of the locations where limit order traders were trapped, trading for trend continuation. But so the entire reason for having high signal frequency is to be able to take the trades that you prefer, and to not have to trade all the time anytime a signal develops. That's really for me, was the most difficult part of trying to trade a swing system, is not being able to ignore signals. So I hope that answers your question. Yeah, so this is, I get what you mean then. So the period when you have a dip in the equity curve of 20 to 30 trades is it caused by a single large loss, or a number of losers within that period that contribute to the accumulated loss? Because that's really where I think you want to look at how much each trade contributes to either profit or loss. One of them, we have a variety of different metrics we use in Systems Academy, but if you have, it just depends on how you are, how the system performs across the various metrics. What the SQN is of the system, what the average profit factor is, and so here, just for example, bar 32, that was kind of a textbook entry for that signal, and if I had taken that, I would be out right now. Like I don't hold the trades, so test there. back to the close of the bar and out. So that would have been it. Lots and lots of those trades throughout the day. And that was what was that? So it would have been 7 points. And no drawdown. So this is the reason why I don't often scale in, is because if you take those kinds of limit order entries, you just don't need to scale in. And if this continues to go up here to test, there'll probably be at least 2 more trades that develop during the leg in the trading range, anticipating that this is going to be a leg in a trading range. So yeah, back to this question though, when you assess the consecutive trades during the drawdown, one of the most important metrics is how long you are in the drawdown for, and how much each of the trades that you take when you're in a drawdown, how much it contributes to getting you back to the previous equity high. So definitely something that you need to study. How many systems have I developed? And so I trade a system that has 6 different signals, but I have developed, I don't know, a dozen different systems. I apologize, but that's not a question that I can answer because it depends entirely on the system. You would like to have an SQN for a manually executed and optimized system certainly above 2 would be ideal. It would not be, or say a profit factor. It's actually probably, whether you're looking at SQN or a profit factor, it's really hard to say. Without knowing how the system is structured, I actually probably can't even suggest what a reasonable SQN is, because, for example, I know people who have been able to get profit factors, so not SQNs, profit factors of close to 3 with almost fully automated system, slight discretionary, inputs, but almost entirely mechanistically, operated system execution. And others, who've done fully optimized, fully automated systems that have a 1.8, profit factor. And so it really depends. And we would need more context in order to understand that. System with minimum drawdown, drawdown intra trade, or drawdown, like absolute drawdown from consecutive losses. Those are different. So you can have drawdowns, during your trades, but if they are recoverable, and they are not unreasonable trades, then the system should just have a generally trending equity curve, and that's really the goal. And you develop that by having a system with high signal frequency and high probability. So basically, a scalping system. Swing systems will result in longer periods of drawdown because of the number of consecutive losses you expect to take. I never say never. I get not really healthy to think in absolutes, but I typically do not hold for 3 bars, for more than 3 bars, because that means that my signal has migrated to a higher time frame. Right? So I find it most useful to think in first principles. The thing that it's telling you, if your signal, say, let's go back to the chart. If this breaks out here, and so if this reversal and follow through that did not break out, instead got a breakout here, and closed near these trading range highs, then that would have been a signal. Well, this is where the 15-minute close. So rather, if this bar broke out and closed up here, then that would tell me that this 15-minute bar has broken out, and now this 5-minute trade has become a 15-minute signal. And then you have different expectations for your calibrated expectations, pullback locations, things that you would be assessing during the next pullback. So all of these are the inputs to the hold times that you would need to figure out. And it's determined by the signal too. It's determined by the system. They're not arbitrary, numbers that I've just come up with. They're determined by the signal and system performance. Better execution. Well, I mean, the thing that we suggest anyone in Systems Academy, we suggest take their system that they develop and then just execute it I think the best way to do it is in market replay with NinjaTrader or multi-charts or any good tick-based market replay, so that you can just get the muscle memory of how it feels to execute the system, so that you just reduce the delta between your research performance and your actual live performance, and so that it just becomes an unconscious process. I think that's probably the best way. And then obviously the forward testing first in sim, and then with the smallest size you can manage, and then scaling up from there. Once you see what the actual delta is, because there's always going to be a delta between research performance and actual performance. But once you know what that is, then you can work with it and practice. And when you see what that delta is and you study it, then and I've done videos on how to study effective study habits. And all of these go into how you end up structuring your replay sessions so that they most directly contribute to the things that you need to be working on in your live trading. So that's how I would do it. What's a pet trade? I don't know what that is. Enlighten me. All right. Well, we've been going for a while. I really appreciate all the comments. This is a really great conversation. I'm gonna stop the share, and thank you all for joining. The reason for today is really because it's really simple. I was rather disheartened by spending more time on the TradingView community forums, by just all of the junk out there, all of the really misleading figures that people post, and the things that they say about systems and signal performance, and the claims that everyone makes. If you do the work yourself to validate your ideas, then you remain in control of everything, and there's no reason to defer that to someone else. So yeah, stick with the work you're doing, and there's no replacement for it. Just you can't do it. So if you have any questions, leave a comment in the comments below. I'll get to them, or send us an email. Happy to chat. But thank you all for being here, and I hope you have a good end to your week and a great weekend. Talk to you soon.